The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague, a man who's never caught behind the curve. It's Anthony McDonald. How are you, Anthony?
Oh, it must be rates week with an intro like that, James.
It certainly is. Well, this week we ask whether the RBA can follow the Federal Reserve and cut rates. We examine what it might take to bring bank shares back to earth and look at the slow, painful death of Tupperware.
James, let's start with everyone's favourite fantastic plastic cupboard filler. This week, Tupperware Brands, the US giant behind the group, went into what's called Chapter 11 bankruptcy protection. Now, Tupperware is hoping they can turn their fortunes around by doing this. But, James, this goose looks cooked, doesn't it?
Absolutely.
Yeah.
This has been one of those slow, painful corporate deaths that we sometimes get, where a company sort of hangs on for 4 or 5 or 6 or 7 years and finally things just get the better of it. So Tupperware has been struggling for a long time. It went through a little period in the last few years where it became a meme stock, like a GameStop in the US. It was so heavily shorted by people who thought it would go out the back door that for some reason retail investors cottoned on and pumped the stock up for a while, but it didn't last because Tupperware's results have just been too poor. So I think what's interesting here, though, is, and we've already heard it this week with a few people saying, oh, but it's an iconic brand. Everybody knows Tupperware. It's synonymous with plastic food storage containers. How could something like that fall over? But I think we see this time and time again, Anthony. A good brand is a wonderful thing to have, but it won't outrun a crappy business model. You know, think of Kodak, think of Blockbuster, think of Borders. They were all businesses that had fantastic brands, but in the end, their business models were just crappy and they had to go under. So I think that's the story with Tupperware. You'd have a bit of Tupperware in the kitchen cupboard, wouldn't you?
James, when I think of Tupperware, I think of being a kid on my grandparents' farm. You get sent up the paddock to work for the day and Nen packs lunch and it's a bunch of Tupperware containers with sandwiches and cakes in them and a thermos. It's funny, isn't it? Like, we all know the brand. It was we saw it a lot more when we were kids, but now we have all these flimsy containers in our cupboard at home. None of them Tupperware, the ones you buy at the supermarket, the red and the clear ones.
Yeah.
And I just wonder, what happened to Tupperware? It was such a good product, right?
Well, of course, they did so much of their sales through direct sales. So, you know, the famous Tupperware parties where a group of people would get together in someone's house and there'd be a demonstration of the Tupperware goods. But that sort of thing went out in the 80s and 90s, but Tupperware actually continued to try and make that work. And I think that's sort of symptomatic of what's happened here. They just sort of refuse to change. And in the end, they've been run over by changing consumer preferences, and that strong brand just hasn't helped. But Anthony, speaking of strong brands, we saw a big move in the worlds of funds management this week with Regal Partners, which I reckon is probably the rising star of the listed funds management sector here in Australia, announcing a takeover bid for Platinum Asset Management, which is a bit like Tupperware. It's got an iconic brand name, but it's actually been in decline for the best part of a decade. So is this a smart deal, Anthony?
Is it a smart deal? Well, it depends if you believe -1 + 1 = 2. I guess, James, this is one of those stronger together deals, you know, two businesses with structural challenges. And there are structural challenges in listed funds management. Just think ETFs, what the big super funds are doing, huge global managers. I mean, if you think putting two of these Australian businesses together and hoping that scale's part of the answer, they can cut costs, look for synergies, try to cross-sell each other's client base, maybe it works. I mean, there's going to be integration issues. There always is. In this case, It's culture. Platinum's got daddy issues with its founders, Kerr Nielsen and Andrew Clifford, that just hasn't sort of got past those. I mean, these deals can work in the short term, these stronger together ones, James, and they can work in the medium term, but they can never make the structural challenge go away.
Yeah.
So we see these deals all the time in coal, oil, petrol stations, traditional media. I mean, we've been part of them one here at Nine Entertainment, James. These sort of industries that are going through big change, things that need to come up with a new business model in order to survive, often try to merge, become bigger, stronger, and make as much money as they can from what they've got while they've got it. Now, I mean, it would be unfair to call Platinum or its style of active funds management a sunset industry, but it is extremely challenged. The world has changed a lot since Platinum, listed nearly 20 years ago. The retail investors, financial advisors, they have a lot of more options they can invest in these days, right? And they can do it much more cheaply via ETFs. So as good as Platinum stock pickers may be, that at the end of the day, in recent years, you've just wanted to own big listed companies, and particularly tech companies in the US, and that's not really Platinum's thing. And the further you've gotten away from that, the harder it's been. So I don't know, James. Platinum, it lost $5 billion in client money last financial year. That's a lot. You know, and when you ended up only managing $13 billion and $5 billion had walked out the door, it kind of says it all. I mean, Regal coming in is not going to reverse that. It will have some ideas maybe to how to revive this legacy brand. Whether it's a good deal or not, it probably comes down to price. I mean, that bit's not really sorted yet. It's only feasible because Platinum shares are trading more cheaply than Regal shares. Yes. So Regal can use its more expensive shares to buy Platinum's cheaper ones, and means Regal can get earnings accretion for its shareholders and offer Platinum something that might be attractive. So, I mean, you can probably tell I'm a little bit doubtful, James. What do you reckon?
Well, look, I mean, Regal Partners co-founder Phil King, he's got this sort of make Platinum great again idea. But I actually don't think that's the big play here. Reviving Platinum would be a extra cherry on top. If Regal can get hold of Platinum's funds under management, if they can improve the investment performance, which has really been terrible for a long period relative to benchmarks, then the Platinum business might at least be able to stem its outflows and find some stability. Then if you could revive the brand, that's one good thing. Or Regal could actually sort of dump the brand and bring those strategies to sit inside some other funds that it's got. So, look, Phil King's extraordinarily canny. I don't think he's sort of putting too much stock in reviving the Platinum brand. That'd be a nice to do rather than a must do. So, as you say, this is all going to be about price. The two parties are talking. I think there's going to be a deal. It seems pretty friendly. So let's see where it gets to, I think.
Yeah, James, it's just another one. Like we've been seeing this all year for the past couple of years, these big funds managers, the ones that, when we started in the industry, we were told to like worship your Paradises, Perpetuals, Platinum, Maple Brown Abbott. I mean, they were, shutting their doors or they're trying to deal their way out of tricky situations, and they're just under so much pressure.
Yeah, says it all. You're right. Okay, Anthony, let's move to the big global story of the week. And after 4 long years, the world's most important central bank has finally cut interest rates for the first time. On Thursday morning our time, Federal Reserve Chairman Jerome Powell surprised economists by announcing the Fed would cut rates by 0.5% to between 4.75 and 5%. Now, we do need to put up our hands here. We didn't think a cut of this size was coming. 50 basis point cuts are usually reserved for emergencies. And the last two came in 2001 when the dot-com bubble was bursting, and then in late 2007 when the GFC was just getting underway. We're not in that sort of situation now, Anthony. So what reason did Powell give us for providing this supersized cut?
Well, sort of because he could, I think, James. So he says the Fed has greater confidence that inflation is headed back to 2%. So he can afford to let the handbrake off a little bit, cut rates by 50 basis points and get monetary policy back closer to what it would consider a neutral setting. Like that point that's sort of not restricting economic growth and not stimulating it either. But really, James, there were mixed messages in it. On one hand, Chairman Powell said the economy was strong overall, GDP growth at 2.2% in the first half of this year, and thinks that's continuing this September quarter. So we got strong overall. He said the labour market was also in a solid condition with unemployment at 4.2%, which is normally means a low, very healthy unemployment rate in his words. So he's telling us it's all strong. And they've cut rates by 50 basis points, which, like you said, is normally something you see in an emergency situation, something to stoke things along. So which is it, James? Is this a want or a need? And I think it's a want, isn't it? Like the US is a credit economy. The Fed likes the idea of low rates. So getting back there as quickly as possible for the economy, for the consumer, it can do it while managing those two goals, maximum employment, stable prices. Or perhaps I just missed the point of it all, James. Like, do you think there was another message in it?
I think Jerome Powell's trying to have it both ways. He's trying to say, look, there's no recession here. I don't even see a downturn coming. But here's a bit of insurance to make sure we don't get to that point. And it's not a small bit of insurance. It's a big bit of insurance.
Yeah.
So that's the confusing bit. It's sort of a really mixed message that, nothing bad's going to happen. But just in case it could, here's a big rate cut. So I don't think you missed the big message at all. It is sort of clear as mud.
Yeah, James, now, like normally everyone loves a rate cut, don't they? Like the markets have been waiting for this one. So investors, they should be happy it's here, should they?
Well, they seem to be. The Wall Street hit a record high, another record high on Thursday night. As we record this podcast, the ASX 200 is surging. It's going to hit another record level on Friday. I think that'll be its third or fourth record for the week. So, hey, look, everything looks pretty good. Investors have been waiting for this rate cut. I would have thought it was priced in. God knows we've heard enough about it. But all of a sudden, it seems investors have sort of got a second win. Now, I don't want to rain on anyone's parade, but let's look at the last three rate cutting cycles. The last three big ones. 2001, after the first rate cut, stocks fell to their worst point. They were down 28.3%. 2007, the GFC, at their lowest, stocks were down 24% after the first rate cut.
Wow.
In 2019, stocks were down 24% at their lowest point after the first rate cut. So history says, hey, a first rate cut is usually something that you want to be very, very, very careful about. But instead, investors are piling into stocks that are already at elevated levels, that are already on extraordinarily high valuations, that are already really crowded. I worry a bit about that. Now, if we're not going to get a recession, if Powell's right, then, hey, maybe this bull market does have legs. But if Powell's wrong and monetary policy does work as it always has with long and variable lags, then there's a chance that the Fed might have kept rates too high for too long, and there could be a hard landing. I hope there isn't, but there could be. So I reckon investors need to be really careful about piling into markets that are already running really hot. But Anthony, that's all happening in America. What everyone wants to know is, does this help the RBA's case to cut rates, or are they still stuck on the sidelines?
Look, it's definitely a consideration for the RBA. What the Fed does, that impacts the US economy. It's a big knock-on impact on the global economy. All of that's important. In the short term alone, the US move immediately impacts the Aussie dollar. It sends it up. That's good for importers. We can buy more with our stronger dollar. Bad for exporters whose goods become more expensive. I think we've seen the Aussie dollar up about 0.5 cent this week on the Fed's move. 68 cents. I mean, that's kind of in and around where it's been trading for the past 3 years. But the RBA has to worry about its own backyard. It's all well and good what's happening in the US, but it's got the same full employment and price stability goals as the Fed, but for the Australian economy, not the US. So here unemployment's similar situation to the US, about 4.2%. Inflation, though, it's still much stronger. And that's the bit that's going to be at the forefront of the RBA's mind. I think it was 3.8% in the June quarter if you annualize the numbers. I mean, the RBA is thinking it's going to be 3% for the full year to the end of December this year, and that's still much higher than where Michelle Bullock and the RBA board want it. So, and then as you wrote yesterday, James, as well, you've got the jobs market here. It's pretty tight. Employment growth up 2.7% in the year to September. That's faster than it was in June. A lot of that growth coming from immigration, about 500,000 new Australians in the past year. So that's not a sign of cooling, is it? It's not a sign it's time to let the handbrake off to return rates to the neutral level as the Fed's doing. So, I mean, we're a bit behind in our own rates journey in Australia as we have been. You know, we were 3 months later to raise rates in 2022. We're going to be later to cut them. 3 months later, I mean, it feels like it's going to be longer than 3 months, don't you think, James?
It might be. I mean, I liked the way I spoke to Paul Bloxham, the chief chief economist, I should say, at HSBC in Australia, used to work at the RBA. He had a great point, you know. The RBA's been more patient, as you said. They lifted rates later. They lifted rates less than the US, and they've been prepared to let inflation run a bit hotter, and they've been prepared to let it come down slower. So, unfortunately, we have to reflect that patience. Now, what Bloxham said is that his concern is that governments are getting impatient. We've seen sort of Jim Chalmers have a bit of a go at the RBA in recent weeks and say that rates are smashing the economy. And you can see that government's trying to respond to that with fiscal support, cost of living measures, employment. I mean, 1 in 2 jobs that is being created in the June quarter came from the public purse. So that's health jobs, administration jobs, jobs related to government construction. So that's the other force the RBA is ironically working against. Government spending is keeping inflation higher than it might ordinarily be. So there's no quick fix for this. We just got to be patient. And it's hard to know exactly how patient we're going to be. Is it February next year? Bloxham says it's not till June next year. Maybe a deterioration in the US economy could force the RBA to act sooner, but it's just too early to tell, I think, at this stage.
Okay, James, put your investor hat on, and not your bond investor hat. Put your equity investor hat on. We don't just want pessimism. What tends to work in rate cuts times like this?
Yeah, well, I've done read a bit of literature on this week. What tends to work is defensives over cyclicals. So that's, you know, defensive sectors are ones where people need to buy the stuff all the time. So think of supermarkets, consumer staples. Think of utilities. That's always been a classic defensive sector. Those are the sorts of things that tend to work. So defensives over cyclicals, large caps over small caps. That sort of makes sense too. Smaller companies have less sort of insulation against an economic slowdown that rate cuts suggest is coming. And you know, if you look in Australia, what's particularly worked is house prices. Housing's been a great place to be in a rate cutting cycle because it tends to help people get into the market and push prices up. So does that work this time given how hard prices have run? I'm not sure, Anthony. But those are the sorts of historical themes. But, you know, we actually have seen some rate cuts around the world already this year. Now, we think the Feds and the RBA are the main game, but we've seen cuts in Switzerland, Canada, Denmark, Sweden, the Eurozone. And what we've seen there is that the performance of share prices or stocks has been pretty middling. And Macquarie's view is that the first cut is a time to reduce risk, not add to risk. So that's what makes me a little bit surprised that markets are running so hard in the wake of this Fed cut this week. So Anthony, speaking of crystal balls, let's dust them off. Where to now for the Fed? Let's start with the Fed. What do you think the Fed does between now and Christmas?
Well, it started the rate cuts, so I think it'll continue them. So I think we'll see a trickle more of rate cuts. There's 2 more meetings, say 25 basis points at each, and I think next year might be time to reassess and deal with the consequences. What about you?
Yeah, I agree. So 50 more basis points, so another 0.5% between now and the end of the year. Now, it's worth noting, Anthony, that the market expects a lot more rate cuts next year, but I reckon this is where the Fed might just want to wait and see. They might want to wait and see how the election pans out and whose big spending, low taxing promises gets enacted. That might be a point of contention. And they might also want to be very sure that these rate cuts don't sort of prime the US economy such that it starts heating up again and inflation starts going again. So I think there's a bit of care to be taken, I think. What about the RBA? Where are we with our predictions there of the first cut?
I still think we're going to sitting on 4.35%. I reckon we'll be on 4.35% through the election campaign, through our election campaign to the middle of next year.
Yeah, I'm still at February.
Yeah,
I'm still at February. I'm holding on. I think by then we'll have a better idea of where the economy's going. I think the RBA wants to cut and deliver some relief to households, and maybe it can use the Fed cut as a bit of a crutch to help it get there. But yeah, I'm struck by how strong the employment market remains, and that's really going to be a concern for the RBA over the next few months.
Yeah, fair enough. All right, James, we've heard about the rate cuts. For our second topic, let's talk about what they mean for our four favourite companies, Australia's big banks. The banks are at the centre of just about everything we do. They're the four most valuable companies on the ASX, and even more than that, they're a big reason why the ASX is pushing new record highs again this week. In particular, James, shares in Commonwealth Bank of Australia and National Australia Bank are on an absolute tear, up 40% and 35% respectively this year, despite rate cuts, despite being amongst the most expensive banks in the world, and despite a sluggish Australian economy which limits their earning growth. James, this run has been so fascinating to watch. And we've been talking about it all year on the podcast. It has taken usually pretty smart investors completely by surprise. When do you think it will stop?
I think my first answer is never. But based on what I've seen this year, banks will just keep going up forever more. People are completely in love with them. They do not want to sell them. They love the dividends. These banks are so big, they can do no wrong. Why would you ever sell it? I'm being silly, but there is that sense that these stocks are bulletproof. And several investors have tried and failed to pinpoint the reason that the banks might fall. The latest one, I wrote about this week. I thought it was really interesting. Brendan Sprouse, really thoughtful analyst from Citi. He had a crack at what could bring the banks down. And what he pointed at was the problem that the banks have got in rising mortgage delinquency. So these are bad debts in the mortgage book. Now, overall, they're only just edging up from very low levels. The banks are really well provisioned. They're watching this like hawks. No great problems. But there is one area of concern, and that's that the mortgage arrears are rising fastest in loans written in 2023 and 2024. Now, you'll remember, Anthony, that a couple of years ago, in the middle of the pandemic, 2021, early 2022, everybody went on to cheap fixed rate mortgages. People filled their boots with these things. And then what happened is they had to refinance after about 2 years. So this is the great mortgage cliff. And so we saw a wave of refinancing in 2023 and 2024 as those people transitioned off very low fixed rate mortgages onto quite high variable rate mortgages. Now, the mortgage cliff was a big sort of point of concern. How would the banks handle this? How would consumers handle it? It looked like everybody had handled it fine. But what we're seeing now is that those loans, those refinance loans written in 2023 and early 2024, are where the most stress are. So Sproule's view is the banks, this is not going to be a big problem for the banks, but could it change sentiment around the banks? Could people start to get worried that this group of customers is, really on the skids as unemployment rises further, that cohort of loans in arrears starts getting bigger? And could that sentiment start to infect the banks and bring their share prices down to earth? I get the theory. I guess the question, Anthony, is we haven't seen any sign of that so far. So is that really going to be the case? I mean, you spoke to Goldman Sachs' bank analyst this week. He's one of many who missed the run. And he's basically had enough. He's been wrong on CBA for 5.25 years, and he's trying to figure out why he was so wrong. Does he sort of agree with Sprouse, or are there other things at play?
Yeah, I mean, it was interesting, James. His name's Andrew Lyons. He was a good sport about it. Like, he's been an analyst for 20 years. He didn't come down in the last shower. Managing director at Goldman Sachs. Like, obviously, he's bright enough.
Knows his stuff.
Works hard. Knows his stuff. Yeah, he put a sell call on CBA shares in June 2019. CBA
Right.
shares were trading at about $80. And now they're
Yes.
firmly into the 140s. And
Yes.
if you add in the dividends over that time as well, you've doubled your money on CBA in the past 5.25 years. Like, it's astonishing performance. So
Amazing.
I mean, Lyons is the first to put up his hand and say he made a bad call, and plenty of other analysts did too. A lot of institutional investors. So he went looking why. And what he found, I mean, he found only less than 1/3 of that outperformance, CBA versus the three other banks, was because of the fundamental reasons. You know, all the things you would normally think drives up a bank share price, like earnings, book growth, dividends, you know, that sort of stuff.
Yeah.
Less than 1/3 of it was because of that. The rest he found was a relatively lower implied cost of equity versus the other big banks. Now that's, James, is an analyst's way of saying CBA shares have gone up just because. You know, he's basically saying there's no fundamental reason. You know, there's nothing you can properly put your finger on. It's sentiment, it's momentum, it's the rise of passive investors. It's all the subjective, but obviously still very important factors.
Yeah.
So, I mean, it puts him and all the other analysts, all the other investors that missed this run, it puts them in a really interesting spot. I mean, do you think that this time is different? Do you cancel your sell call and adjust the way you value CBA shares? Or do you follow the rule book? You do follow your years of hard work and training and say, no, this thing has to come back to earth. And for me, James, that's what makes this so fascinating. And it's fascinating because, you know, fortunately, I'm not in the position where I have to have a buy, hold, or a sell on CBA. And it's not impacting my performance in terms of my job. But I mean, Lyons is like so many others out there that we speak to, James. They freaked out when CBA shares hit $100 in 2021. They freaked out when it hit 110 in 2023, 120 earlier this year, 130 in May, 140 this month. It's a huge run, and they've been wrong the whole way through it. It's just absolutely fascinating. James,
Totally.
like this week, it's on again. We've seen another leg up in CBA shares, another leg up in National Australia Bank. If anything, the increase only seems to be accelerating. Is there something that new that has happened like now? Is this about rate cuts? Is it about house prices or those unemployment numbers we were talking about?
I think it's just because. I mean, there's been no data out on the banks. Matt Common from CBA hasn't said anything. The chief executive of NAB, Andrew Irvine, hasn't been around town talking the bank up. Nothing's happened. I mean, I guess the one thing, and I've heard this theory, you would have heard it from fund managers too, Anthony. The world's an uncertain place. We've just talked about what's going to happen after this first Fed rate cut. Nobody knows what's going on. People are looking at the other big sector in the ASX 200, mining. They're thinking about China. They're thinking, oh, that looks pretty ugly. I don't know if I want to increase my exposure to the likes of BHP and Rio and Fortescue. So where do you put the marginal dollar when you're feeling uncertain, when the world seems risky? You put it in the safest place in the entire market, and that is the bank's stocks. So I wonder if it's just about that. We're seeing this time and time again as the world gets more uncertain and riskier. People flock back to these winners. It's not logical. These stocks are hugely overvalued. They're past the point of being justifiably valued for anyone. I don't think even Matt Common could make the case that CBA is sort of reasonably priced at these levels.
Approaching fair value, he says, James.
But look, it's just the safe place to be. You know, I talked about house prices. The banks are so well insulated against a housing crash. It would take an extraordinary economy-destroying depression for the housing market to be a real concern for the banks. They're so well provisioned. They watch this stuff so closely. So I think this is about just the next safest place to be is in these winners, and that's where they're going to be. I mean, what do you think it says about the ASX, if anything, that these stocks can keep running with little or no earnings growth, Anthony?
I think it's such a good question. And I think it says a lot. I mean, this combines changes in capital markets, you know, specifically the rise of passive investing and ETFs that we were talking about at the top of the program. It combines that with Australia's insanely expensive housing market, the resilient economy, the jobs market, the immigration. And like you said, what investors are after, these big companies, stable returns, like there is bugger all earnings growth in the banks. The banks have been on a one-way trip to lower returns for shareholders for the past 20 years. All of the regulation, the capital requirements, the compliance, all of that has made them bigger and safer, but it's also made them less profitable for shareholders.
Yep.
And you'd think that makes them less valuable for investors, but it's actually made them more valuable, because of that stability, because there's less fears about them blowing up. So, while the Australian economy has been resilient, it's been propped up by, iron ore, coal, gas, immigration, government spending, all of which helps the banks. I think there are concerns about China and the slowing economic growth in China. I mean, that's driven people away from the alternative to the big banks, the big miners.
Big miners, yep.
And it's probably shifted more of that money towards the banks. So, but we can look around and think about what it means for markets, what it means for the banks, but I don't think there's any firm answers in any of it, to be honest. James, the one thing though that makes me think that the market is working, and surely it can't be a coincidence, is that the shares that are running is Commonwealth Bank, National Australia Bank and Macquarie. And they're the three banks with the three most valuable things in Australian banking. CBA in that retail deposit base, NAB in the business bank, and Macquarie in the tech platform it's built in the past 5 to 10 years. Admittedly, it's much smaller than the other four when it comes to deposits and mortgages. But they are the three best bits of Australian banking, and they're the three companies whose shares are running the hardest.
Very well put, Anthony. Let's have a break now and we'll come back and we'll look at another question about bank investments. Welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and the best bits of this podcast and delivers them straight to your inbox. All right, Anthony, another busy week looms. The AFR's got its crypto summit on Monday. Yes, crypto's still a thing. Prices are a bit depressed, but there's a fascinating guest coming up here, Anthony, and that's Anthony Scaramucci, the Mooch, who for about 15 seconds was the White House press secretary under Donald Trump, now is very stridently anti-Trump. So that'll be a bit of fun to hear his views on politics and crypto.
Yeah, absolutely. And, CBA shares are up 40% in the past year. James, Bitcoin, in Australian dollar terms, 120% in the past year.
Wow. Wow. Fantastic. Well, that'll be... That is a big gain, and maybe it's up just because too. Yeah. On Tuesday, of course, the RBA finishes its meeting. We're expecting no cut here, Anthony, but it'll be interesting to hear Bullock on the Fed and where she sees the jobs market.
Yep.
And then we get a little run of earnings results. Premier Investments, Solomon Lew's big retail giant, has its results out on Wednesday, and I think Sol Pat's, the famous investment house conglomerate, whatever you want to call it, also has a result next week. So that'll be interesting too.
Yeah, absolutely. We saw Premier's mates at Myer had their results this morning, James, and, there's still tough times in the sector, and the talks between Myer and Premier about the merger of some of the divisions are ongoing. Yeah.
Well, we love questions here on the Chanticleer podcast, and this week our question is from Lockie from Coonawarra. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it to us. So Lockie asks, "Hi Anthony and James, thanks for the great work you're doing. Really enjoy the podcast each week. My question is around the changes proposed by APRA, that's the prudential regulator, to the ASX-listed bank hybrid market. Hybrids have been a good source of reasonably high yield at low risk for retail investors. Their removal will leave a big hole in the range of options available, particularly given we don't have an active retail bond market in Australia. What do you think are the implications for those securities that are currently listed in terms of price and liquidity, and what are the best alternatives available?" Lockie from Coonawarra. Well, Lockie, you're making me dream of a glass of wine right now, but let's focus on the question at hand. Anthony, this is a big change. Do you want to tell us a little bit about what hybrids are?
Yeah, basically. So hybrids are sort of like a mixture of debt and equity, James. So you typically buy them and they'll pay you money a couple of times a year. You know, say at 5 or 10% rate, just depending what the markets are like. And you typically sign up for like 5 years, and most of the time you look at them as a yield sort of investment. I remember James doing work experience at a financial advisor. This is years and years ago, different times. But, you know, this financial advisor looked after wealthy individuals and families, you know, doctors and people with, you know, $10 million or $50 million. And their portfolios were very Australian equities heavy. But when it came to the yield section of the portfolio, there was basically two options. It was either utility stocks, like your Duet and Investor and Spark, all that stuff that's disappeared, or hybrids.
Yep.
It was mainly the bank hybrids. The bank hybrids, they sort of pay normally 4 or 5% above the cash rate. You buy one, it lasts for 3 years, 5 years, and then you roll it into the next one. So, yeah, APRA's come out. It wants to end the bank hybrids and really like signaled the end of an era. It's been for more than 20 years now. They've been hugely popular with wealthy Australians.
And APRA's concern here relates to something that happened last year. That was the collapse of Credit Suisse, which also had bank hybrids on issue. And what APRA is concerned about is that because they are both debt and equity, they're sort of neither. Mm-hmm. And so what APRA's worried about is financial stability, as in, will these instruments help or hinder the bank in the event that it collapses or goes under? APRA's view is that they will hinder the financial stability of the Australian market in the event of a collapse, the very unlikely event of a collapse. And so that's why APRA's moving away wants the market to move away from them. Now, there's a pretty long period of transition here, Anthony, but it is, to Lockie's point, going to leave quite a hole in the market.
Something else will come up, James. It's just too big a pocket of money. So I think there's $43 billion in bank hybrids at the moment. Well, that's a big pool of capital. Something else will come up and replace them in terms of investment product. It's just too big, too lucrative, like a sector of the market to disappear. I mean, already we see there's listed investment companies, listed investment trusts that are sort of doing the same thing, sometimes based on like credit investments, sometimes based on equities, but that same sort of yield offer, trade in and out, like liquidity for the underlying investor. Imagine that gets bigger, or perhaps it's something we haven't even dreamed of yet.
Yeah. But you're right, Lockie. This will leave a hole in the market, and as Anthony says, something will fill it. We're just not exactly sure what that'll look like at this stage, and it'll be a bit of a rotation for investors to figure out where their portfolio goes next. All right, Anthony, thanks for another great week. Big week next week. RBA, Premier, and maybe a little date with the mooch to see where he thinks the election's going. Should be great fun.
Yeah, absolutely, James.
Thank you, and we'll see you next week. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At The Financial Review, we investigate the big stories about business, markets and power. For more, go to afr.com and you can subscribe to The Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson and Anthony McDonald, and it was produced by Alex Gow and Lap Fan. Our theme is by Alex Gow. The executive producer is Fiona Buffini.
The Australian Financial Review.